How's everybody? Did one of you move this?
Yeah, I moved it when I got it.
Do you not want me to use it?
No, it's fine. I thought it would be my way, but it's actually fine.
All right. How is everybody doing? Terrific. So before we start, I got to take attendance, right? See how this thing works. Good pain in the rear end, man. Right? And I can't figure out how to hide this people. That's what I've been up here farting around with. Anybody know? I'm trying to hide these other people. Yeah, so anyway, I have to figure that out. You would think I was like some kind of old fart, right? But I do know what I'm doing. Well, Marco, William, Angelo, Martin, Connor. What's your name?
Matt.
Brilo Braddock?
Yeah.
Hunter? Dimitri? James? Joe? Nicholas? Joe? Joe Fisher? Joe Papano? Brendan? Nolan? Nick? Slider? Charlie? Ryan? Patrick? Sean? Who are all you other people? Oh, you were in the early, you weren't supposed to be here earlier. And you changed your mind. Jackson. Who else didn't I call? Okay. This is a nightmare. Anybody else? Okay. This is a nightmare. This thing doesn't correspond at all to where you guys are sitting. I don't know what's going on. All right. So before we get into anything, what else is there? Any questions? I'm a little bit confused. I'm sorry. Say what? How many of you have your own accounts and you trade stocks? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, many of you guys are in sim? Only a couple. So the rest of you are into trading stocks on your own because you want to. What sort of platform do you use? Robinhood, TD Ameritrade, Fidelity, Robinhood, Cash App. How many are into GameStop? No? None of you. How come?
I put some money into AMC.
Did you Robinhood stop that?
They stopped buying it, people would sell it.
They won't sell.
Yeah.
What do you think of this, you guys? Say it louder. It should be illegal. What they did? You mean shutting you out? You want to buy more? You should be able to do that. Why did they say they stopped purchases?
The volatility. They said they were trying to protect customers from potentially the volatile market.
Fiduciary responsibility, did they say something like that?
I didn't those words, but
Anybody see the Wall Street Journal article on the founder of the Wall Street Bets, you know, the Reddit, Wall Street Bets? Anybody see that article? Says it looks like it's a train wreck in slow motion. You see it?
I know what's going on. I see this article.
Well, what do you guys think, man? I'm fascinated by this. As an old guy, you know, someday I'll show videos of the old days, the way men did it, and women.
Jimmy Cortez called for a lawsuit. I think she tweeted it, and then there was another politician who backed it up against Robinhood.
Oh yeah?
Yeah, I want to say that myself.
Yeah, that sounds interesting, right? Well, I mean, come on, talk. What do you guys think about this? Go ahead.
I think it's fine.
It's funny?
Yeah, a little bit.
So here's what I understand. Go ahead.
I think it's funny too, because you had like a bunch of like Wall Street betting against GameStop, and it was like, and then the people, small people online on like Reddit, they were like, no, you guys took out big one.
It's like an internet poll.
Yeah.
What?
It's like a poll.
It's like a poll.
one of like the arguments is that Wall Street is like big time hedge fund managers are like corrupt. Do you like find that working on Wall Street?
No. Not necessarily, no.
You thought a little bit about it.
What do you mean?
I mean, like what you every day.
Yes, I can. I spend more time in London, trading on the floor in London. I'll bring up some pictures, maybe. So we were floor traders. You know, I did what's called arbitrage. I think I might have talked a little bit about it the other day. Arbitrage is simultaneously buying and selling a product that should be worth the same. It's not. Right? So I would buy bonds in Germany. They were also traded in London at a lower price and sell them in London and just do it all day long. It was a little bit like a video game, but it was live, you know. I used to have a broker in the pit, signal to the broker what to do, and I had a phone to Germany, and I would listen to the market in Germany and sell it.
were you putting clients' money or how much, or for your money, or how much capital were you trading?
I was trading for a private trading firm. We had no clients. Two guys that were wealthy that backed us, but and they still do that, I think. But they would back you. So they would put up, in my case, maybe I needed about $10 million. So, and then you split the profits with it, you know? They'd start out and say, well, I'll put up $10 million and you trade, and I'll give you 30%. And then, you know, you do well, say you make $1 million, you make 300,000. They'll say, okay, we'll go 50. These guys, the guys that I worked for were very well. One of them was an owner of the Golden State Warriors. He early on, a lot of time, he sold out the Golden State Warriors for, he made like $100 million on that. You know, on that investment. There he came into the office and said, now I really don't have. Right? How much money do you need not to work? I used to think if I had $2 million, but I don't think $2 million is going to get you very far. So after this conversation, I'll put some pictures up, maybe if I can find some on the interwebby thing. The other class thought, yeah, this is all about Wall Street elite. Controlling how we behave and what we do. Yeah? It's a conspiracy. How many think that this is a conspiracy? That they're manipulating what we can do and can't do. To some extent they are, right? By shutting down our options. But is there value in the stock? Does it exist? Is it real? So they're just trying to protect the short seller. Is it sitting up? It's the seller, right? Betting on the downfall. And they're getting their ass kicked. Yeah? So I just think it's interesting that it's amazing to me that like 17 or 20 of you said you have your own accounts and trade stocks. That's fantastic. Yeah. That's great. So let me see. So this was the trading floor. Oh, you can't even see it, can you? It's hard to see, right? So you see the guy going like this? That means he's buying this. Five bid at 6, 5 bid at 6. So buying was always towards you, right? You always paid price first. So if you paid 6 for 10, for example, this would be 6, right? This is 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10 would be up here. Or 10 would be even. So you'd say pay 6 for 10. Singles down here, 1, 2, 3, 6. Quantity, right? So you pay price first. So 8 for 54. So that's what they're doing. Those guys that are going like this, you know, we did that, we didn't do this. It's hard to see. I knew all those guys. See, okay, so enough of that. Let's get on with our day, shall we? I'm happy to talk more about this whenever, okay? So here's where we left off the other day. We talked about the role of the financial markets in our economy, right? The informational role, consumption timing, and allocation of risk. And I put some stuff up on the board, I think, didn't I? So let's talk about in the stock market, for example, agency problems. So the ownership of a company is not necessarily the management of a company. That creates the agency problem, right? You guys have been beat to death with the agency problem in all your other courses, right? Corporate finance and economics, yeah, they talk about the agency problem a lot. Ownership of the company is not necessarily management. Hey, how many are in institutions in markets? 1, 2, 3, 4. What are you doing now? Is Giles isn't around? What's going on?
Just sent out some notes.
Oh yeah. So you just got to read the notes and keep up. Ownership is not necessarily management, right? This creates the agency problem. So how do we take care of this problem? See, when we're talking about equities, we bought the stock. We're the owners of the company. Yeah, you buy equity in a company, you're the owner. You're not doing anything about managing it, are you? So how do we make sure that they act in our interest? That's the problem, isn't it? Mechanisms to mitigate agency problems. Tie managers' income to the success of the firm. Well, that's a good idea, right? Monitoring from the board of directors, monitoring by large investors, security analysts, and takeover threat. Well, what about this tie manager's income to the success of the firm? In other words, this dude gets paid if this dude performs. How's that going to work out? Any ideas? Is it a good idea? Kids, I can't see because of the gray. So you need to raise your hands higher than that. Yes, it's a good idea. Chairman Lee, it's a good idea. What could go wrong? Could it go wrong? Could go wrong, no? Can we prevent it from going wrong? How could it go wrong? Well, you got to monitor it. Okay, so here's the problem. If you do it short term, right? If we hire a manager to run our company short term, we say short term, we're going to pay you according to how well you do. Well, the dude maybe is going to use cheap stuff. Yeah? Like make bicycles with tin or something to make it, to boost profits. Yeah, and then in a year or two, when all those bicycles fall apart, he's going to like jump ship. Yeah, that's a problem. What if we say, let's vest them for 10 years? So you've got to make good profits for 10 years. Maybe that will work. Yeah, got to have some kind of a constraint on it, don't we? Corporate governance and corporate ethics. So this is all before your time. Accounting scandals, Enron, auditors were watchdogs, and analysts like Arthur Andersen. Between 2000 and 2002, there were an endless number of scandals in the corporate America. Some things like Arthur Andersen, they would audit a firm, but they were also the analysts for the firm. Yeah, that's kind of a conflict of interest. So we started Sarbanes-Oxley. This was meant to curb some of this corruption. They said that firms had to have independent directors, right? Be on the board of directors. They had to be independent from the firm. In other words, you couldn't be a manager of the firm and be on the board of directors. CFO had to personally vouch for the financial statements of a firm, according to Sarbanes-Oxley. No more could we have somebody like Arthur Andersen, which of course is their history now. But no more could the auditor also be a consulting analyst for the company. Yeah, some changes that we tried to make to mitigate this agency problem. Okay, so how do we do investments? How do we make investments? A portfolio, as in a collection of investment assets. We have two decisions to make: asset allocation and security selection. This thing working out okay? Writing on this board and people are able to see. I know Khalid Amir was saying he got this thing, but I don't want to sit here and write. I don't know. That's not enough energy for me, maybe. investments broken down into stocks, bonds, real estate, commodities, etc. So investors make these two types of decisions. Okay. Asset allocation and then security selection. We have two approaches, a top-down approach and a bottom-up approach. So top-down, asset allocation followed by security choice. Bottom-up, investment based solely on the price attractiveness. So I want to make I'll put this on the board. Draw a picture. I like to draw pictures. So we have a top-down approach. Imagine your portfolio. So you take your money, right, whatever it is, and then you decide, I'm going to put some money in cash. Yeah, you got to keep some money liquid in case you need to buy a new minivan or something, right? I'm going to put most of my money in equities, stocks, yeah. Some of my money in bonds, right? So what determines how much of this, you want this allocated between equities and bonds? How risky you want to be, yeah? You're going to take, because which is more risky? The bond, the equities, yeah, stocks, right? So this may work for you guys, right? Whereas somebody like me, I want to be a little bit more conservative, right? I'm going to retire, hopefully, 10 years maybe. You guys are going to have to go work for, well, depending on how much of that GameStop you bought. You're going to have to go work for a while. So from this place, you say, okay, here I want utilities. Utilities, I spelled wrong. And you want some growth stocks. You want dividend paying stocks, right? In other words, here you want some bonds, maybe some 5 years, some 10 years, some 30-year. Yeah, you want to spread it out across different investments, et cetera, et cetera. So this is a top-down approach. Bottom-up approach, you're not doing that. You still got a portfolio. Yeah, maybe 100 grand. But you're saying, I'll stop. Because your roommate said, you got to get in on this, man. Buy some of this, right? So you buy it, you put it in your portfolio, yeah? And we have another hot stop. Yeah. And then next month it's something else, right? So you get in on this, right? And another. Yeah. You wind up with probably the kinds of things that you guys are interested in. Maybe technology companies, yeah? New downloads, the newest, thing, yeah? So you buy that company right because you're young, you're like, yeah, that is so cool. Yeah? Well, I don't even know what it is, right? You wind up with very heavy, yeah. Maybe, you know, maybe something else. Maybe you're interested in something else, you know, but you get the idea, right? So, oh. Say it again, I'm sorry. Well, that's right. You're just buying stuff because people have said, oh, get in on this, get in on that. You know, they could have said, there's a new bond issue. You know, it could be a company that's issuing bond instead of selling shares. Yeah. And they may have a new payout program associated with that bond. You know, that you like, that you want to be in it or whatever. You know? So no, it doesn't have to all be equity. You know, it could be, that's a great question. It could be, it could be real estate. Yeah, it could be oxygen bars, right? When I was in London trading, a lot of guys would buy a restaurant, you know, thinking, this is going to be the best thing, right? I remember one time that guy, Gordon Ramsay, everybody know Gordon Ramsay? He had a restaurant called Aubergine. So I went to it. Man, it was expensive. But as somebody I worked with had made reservations. You had to make a reservation like a year in advance. So he made a reservation for 4, and he invited me and my girlfriend, and him and his girlfriend. But guys were all into all kinds of things. You know, like, let's invest in oxygen bars, right? There you go. And we just, what's another cool thing to do? These are things you got to do when you're in college, right? Kids, right? You go to an oxygen bar. What's the other thing, man? Where you go and lay in a tub of water and close the roof? Sensory deprivation. Sensory deprivation. How many have done that? No. I'd love to try that, you know?
You would?
Yeah, I'd love to try it.
I think I lose my mind.
Yeah?
What is it?
It's like you're just like floating, and you can't see anything, you can't hear anything.
You get into a pod, right? And it's salt water, so you float really easy. And they play music, and you lay there floating. And they close it up. So you just total darkness. And they play music. And you just let it chill out.
Is it like 10 minutes or like hours?
Probably
Now, days, days.
you know, you got to take for maybe 30 minutes. So you go to a bar and you put oxygen. You know how you get oxygen on if you're in the hospital or something. So you sign up and you go sit down and they give you a mask and you breathe oxygen for 30 minutes. What's that?
There's one that's just over.
Here?
Yeah, pretty sure.
Really?
Just so you go inside somewhere away from the pressure.
Well, they give you a mask. like if the EMS carted you off, they put a mask on you and feed you off. It's supposed to make you feel more invigorated.
Yeah, you get like flavor drops.
Yeah, I'm sure you did. I'm sure you did. Yeah. Okay, so your portfolio maybe is oxygen bars and sensory deprivation tanks and some hot stocks that your roommate told you about, right? Clearly, you're making more money than sense. All right. So that's that. Risk return trade-off. Higher risk assets are priced to offer higher expected returns than lower risk assets. Does that make sense? Risk and expected return are positively correlated. Does that make sense? I'm not going to write all these notes on the board, but I'm going to go and draw a little picture because I like pictures. Always in this class, it's about risk and return. Yeah, there's always some kind of relationship. The higher the amount of risk, the higher your expected return, right? Otherwise, why? Yeah? The lower the risk, the less you're probably going to make. If a higher return can be made without extra risk, the price of that investment will go up, making that investment less attractive. Naturally, right? So these are positively correlated, although I sometimes wonder, yeah, we talk about the rational expectations. When in a minute we'll talk about the efficient market hypothesis. But everybody buys this rational expectations theory that people are rational, that this is rational. We say, oh, this relationship exists. But I say, I'm not so sure, because we all know somebody that maybe goes to a bar to pick a fight. Yeah? They don't even care if they win or lose a fight. Am I right? They just want the freaking buzz of going into the bar for a fight. Yeah? That's not rational, but they exist. There's people that go to the casino, yeah, and they know they're going to lose eventually, but they want the buzz of doing it. So, everybody else would tell you, this is rational and rational expectations exist, but I'm not sold 100% on it. Okay, the efficient market hypothesis. Efficient markets. Prices quickly adjust to all available relevant information. There should be neither underpriced nor overpriced securities. What does that mean? Yeah.
Sorry. The whole game stuff thing. After the whole game stuff.
Whole game?
Game stuff.
Oh.
Rational market and all that.
Well, that's the question. We're trying to say, why are people buying this stock? Yeah? Because they think Wall Street is messing with it. Yeah? The stock isn't worth it. No, it's not worth it. But people are buying it. They want to see it go to $1,000. Yeah, and they want to show Wall Street that they're not the boss of them. Yeah, they're pissed off. It's this whole conspiracy theory thing. Like, who won the election? There's a lot of people that think that the president now is not the one that won the election. Right? I mean, that's what I gather from the news. Is that what you guys gather? So, I think it's indicative of a larger problem that people are pissed off. Yeah? And this is just, I mean, this stock doesn't belong at $1,000. So, but yes, theoretically, people are rational investors. And we could say that even the GameStop people are rational because they anticipate that they will be able to buy it and sell it at a higher price. That's the whole point. Whether it's actually valued there or not is a different question. And even the guy that's going into the bar just for a fight, he's still probably rational because he gets a utility from the adrenaline of being in the fight, right? That's what Wilson would tell you, that they're both rational, yeah? I say, see, I don't get that much of a buzz from getting beaten up. All right, so I came over here to write something. Oh. The efficient market hypothesis. Somebody tell me what this is? All available information is priced into the market. What does that say? What does that mean? What does that mean for us? What does that mean when we say hot stock?
Is that like just saying if there were a fish market, fair value would always be market value?
Yeah, everything would be priced at fair value. Exactly. That's exactly right. Thank you. Which means throw a dart at the financial pages of the newspaper and buy that stock. Yeah? You're just as likely to do as well as any other stock because everything is fairly priced. Well, we don't know if that's true, do we? I mean, Wall Street, Charlotte, they all have these financial firms where you guys could go get jobs as analysts, yeah, when you graduate from here. Maybe somewhere warmer. That says that this doesn't hold, does it? We have two strategies, passive management and active management. Passive management means that this holds, that you just take your 100 grand and you put it in a asset allocated portfolio diversified. You don't try to find winners or losers. You don't try to buy ahead of the earnings report or sell ahead of the earnings report, right? As opposed to active management when you're really doing that. You're really trying to buy in the stock that your roommate told you about. What does that say about being an analyst? Asset management, what does that mean? Anybody familiar with Catch-22? Did you have to read that in high school? It's a Catch-22. If markets if the markets were 100% efficient, then there would be no point in trying to find a good value stock. But if there were no active management and research into the best companies, the market would stray away from 100% efficient. So we have these people doing security analysis, making sure that everything is fairly priced. Okay, so who are the players in the financial market? Who supplies capital? You and me, right? We go to the bank, deposit our money, so the bank can lend it to Dresser Rand so they can build a new machine or something like that. The demanders of capital are firms, Dresser Rand, looking to build a new machine. What about the government? They could be buyers or sellers, buyers or lenders. What are they usually? Borrowers or lenders, the government. Yeah? Well, yeah. For the government to lend out more than they need, that would mean that the government has a surplus, right? guys ever heard of the government having a surplus? Have you ever heard that the government is having a deficit? The government almost always has a deficit. Bill Clinton was the last president to say, I balanced the budget. Right? How old were y'all when Bill Clinton was president? You weren't even, you weren't old, right? You were that old. So the government usually runs a deficit. They usually borrow. They spend more than they collect. How do they collect? They collect our tax money. Yeah. And then they spend it on programs, Social Security, so not Social Security, but unemployment insurance, building roads and bridges and military and all that other stuff, right? Financial intermediaries, they are also in the players pool and invest funds, investment companies, banks, insurance companies, credit unions. These are the entities that bring suppliers together with the demanders of capital. You have people who have extra capital and people who want extra capital. Banks, they make money on the spread, right? How do they make money? We go there with our money, invested it. We go to the bank and say, here, hang on to this money Grandma just gave me for graduating. And they pay interest, right? And then they take that money and they give it to somebody else, maybe who's buying a house or a new minivan. Yeah, and they charge that new minivan buyer more than they're paying you, right? That's how they make money, right? They make money on the spread. Investment companies, they allow for economies of scale. So small players in an investment company can get the same benefits as a big player. If you wanted to go buy shares of some new company, it would be very expensive for you to pay all the commissions and fees associated, and there might be a minimum purchase, right? But if you put your money into a mutual fund that owns that company, you can get in on board for a lot less money. Yeah? So that's what we call economies of scale. And insurance companies and credit unions, they also offer similar advantages, right? Pooling money allows them to lend considerable sums of money. They take our money that we brought to the credit union to invest, and they put it all together, and then they can make a big loan. They can also achieve significant diversification. So if you go and you get into a mutual fund or something, you can spread your money across a number of different sectors. And they build expertise through build expertise through the volume that they do. So this is one of my favorite things, right? So maybe you want to set up a trading company, yeah? You want to trade, you got 4 buddies, so you want to go to the bank over there, right? Across the street, community bank, and borrow 100 grand. So you can start, you got a new company you set up, Bond Buddies or something. What's a bank, community bank going to say? They're going to very politely say, get lost, right? We're not giving 100 grand to 5 bond venture students so they can trade it in the stock market. But if you went to a bank on Wall Street, you could do it. They would say, okay, the guy's got the perspectives in his drawings. He's going to say, okay, 100 grand here, blah, 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 blah. Here's paperwork, and he set you up, right? So they have expertise in that sort of thing. Community bank does not, right? But community bank is perfect if you need a mortgage for a house now. Yeah, Wall Street's not going to do that. You know. Okay, I think you get the idea. Banking activities. Uh, investment banking and commercial banking. Investment banking, they underwrite new securities. If you had a company and you want to take that company public, you would go to an investment bank, right? And they would say, oh yeah, we can do that for you. You know, you need $10 million and we're going to issue shares in your company in the primary market, right? You would get the $10 million, they would issue the shares. Those shares would subsequently trade in the secondary market, like the New York Stock Exchange or something like that. And you never get any more than the $10 million that you initially got when you offered your shares out, right? That's the primary market. Contrast that to commercial banking where they just take your money and they make loans. Yeah, you go to a commercial bank and they take deposits and loan money out. So we have talked about the financial crisis of 2008. Antecedents of the crisis is the Great Moderation, what they call the Great Moderation. And a historic boom in the housing market. So in 2000 and 2002, there was a tech bubble implosion. Back in 2000, we saw very similar to what we're seeing now with these stocks that we were talking about earlier, right? GameStop and some of the others. These stocks were trading at many, many, many times their value, you know, in the tech sector. And that exploded in about 2002. So a lot of people got hurt. I remember a friend of mine was all set to retire. He had worked at Morgan Stanley for a long time, and the tech bubble burst, and he didn't retire. He went back to Long Island. I think he became a life coach or something. The Fed responded by aggressively reducing interest rates. What does that do? We were just a minute ago talking about fiscal policy, right? Not fiscal policy, monetary policy. Huh? Yeah, it puts money out into the economy, right? That's exactly what it does. So the Fed says, oh man, we got to get people spending money. So we're going to cut interest rates and make money available, right? Interest rates now are very low. It's like free money, you know? So this cut in interest rates enabled many, many, many people to buy houses, right? They could afford to get a mortgage and buy a house, which fueled this housing market boom. So we saw this historic boom in the housing market. This is the period they're calling the Great Moderation. And can't really see very well. Takes away a lot of control. Anyway, the Great Moderation, and now we have the LIBOR, the T-bill rate, and the TED spread. What does LIBOR stand for? What are T-bills? What's the TED spread? LIBOR. London interbank offered rate, similar to Fed funds, right? It's the rate at which banks loan money to each other. What else did the slide talk about? The TED spread, the Treasury bill euro dollar rate spread. And the T-bill rate. Short-term rates. These are all very short-term rates. So we see them crashed almost nothing here. The financial crisis of 2008, this is that historic boom in the housing market, right? Imagine here if, say, let's pick a spot, 1998, you bought a house for $90,000, right? 10 years later, in 2007, let's say you bought it in 96 and sold it in 2006, $80,000 and $180,000. That's more than 100% return on buying a house. This was the boom in the housing market because the money was cheap, money was free. The Fed had reduced interest rates so much that everybody was buying homes, right? Driving the price up. So this led to a change in the way we did it, housing finance. The old way was local thrift institutions made mortgage loans to homeowners. Thrifts possessed a portfolio of long-term mortgage loans, and their main liability was deposits that people went and brought to that bank. So the idea was originate the mortgage to hold. So in a nutshell, you wanted to buy a house in Allegheny, so you went to Community Bank, and Community Bank took a look at all your financial information, and they said, yeah, you're going to be a professor at Bonaventure, you're going to have an income, you've got some money saved up, we'll loan you the money for the house, right? And you're a good credit risk, and you buy the house, and Community Bank keeps it in their portfolio. In other words, they hold it for the 30 years, right? And they have hundreds of them in their portfolio. And that's one of the things they did. One of their segments of business in the bank, you know. Well, that all changed when, in the 2000s, in the run-up to 2008, so many people were buying houses, yeah, and the interest rates were so low, we adopted this new policy of securitization. So Community Bank no longer would hold the loan, they would make the loan to you and then sell it. So they weren't interested, were you going to stay at Bonaventure and teach for 30 years and pay the loan back? They were interested in selling the loan to somebody else. Bank of America. Bank of America would take it. They would buy hundreds of mortgages, and they would package them into mortgage-backed securities. They would take tranches, and construct these mortgage-backed securities, which were made up of maybe 7 out of 10, where there were people with good credit, where they were likely to pay the loan back. And then 3 out of 10, where those people maybe didn't even have a job. Yeah, they were not good credit risks. So this changed the way we did the mortgage business. And this was a contributing factor to the 2008 crisis. So I just want to put up here, and I'll just look at the slide quick. to show you, I want to talk about Fannie Mae and Freddie Mac. These are government agencies, right? Fannie Mae and Freddie Mac. So I'm going to put what these are. They were the first government agencies to do this securitization of mortgages. I keep tripping on that. Freddie Mac. These are the acronyms. Federal Home Loan Mortgage Corporation. And these government agencies were the first to start developing these mortgage-backed securities. And it became such a huge business that private firms also got involved in securitizing. They would buy 100 mortgages from Bank of America, strip them up and sell securities based on them. And as we know, many people that bought homes in that period were unable to pay their mortgages eventually, and created a big problem. All right, should we call it quits? Just about time for the weekend, right? All right, everybody, thank you. Have a good weekend.